Some clarification on what I mean by comparing the risk-free rate to some outstanding short options, how I calculate that, and your questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we take your questions and talk about the markets and options. And we had a viewer reach out over the weekend who was looking for a little bit of clarification. I don't know if we can get the question up. I'm going to read it from the other screen where I have it. Phoenix WK2 asks, "Hi, Mike. Thanks for doing these videos. I've been learning a ton and recently started reading your book. In a future video, would you mind rerunning through how you calculated the current yield on an open put versus the risk-free rate? If I'm following correctly, you are essentially looking at the return on risk using the current mark price rather than the initial premium received versus the risk-free rate through the remaining days to expiration." The current mark price, that is correct, using the current options price relative usually to the strike. It should be said if it's a put, because that's essentially what the risk is that you're taking. So let's see if we can walk through an example really quickly and see what something like this might look like. I don't know that it matters. Let's see if I can just choose an option. Now, there are different people look at this differently. One way that people tend to look at this is versus margin. So there are some folks who look at the return on margin. I don't like to do that because I'm not sure that the margin is necessarily the way I think about what the maximum risk is. You could have a very high probability that you are not at risk and still be short an option that I wouldn't necessarily be immensely comfortable with. But if I walk through an example, it might be a little bit easier. So I'm just going to put in a short put here for our example. We'll use mid-market prices if we like. And we're going to, why don't we just go out to just December regular way. That's an expiration that's coming right up. So that's going to be on Friday. And let's assume, so let's just think about this for a second. Maybe I can go to, let's take a look at these 88.5s. Okay. So the 88.5 puts, these are, if one was short these, you're short these at 17 cents. And what's the risk here? The risk is that you own the stock at 88.5. We'll get to the likelihood that that happens in a moment, but we'll just start with that. So I would take the 17 cents and I would divide it by the strike, and that gets me to 19 basis points. All right, so if everybody's following along at home, 17 cents divided by $88.5 is 19 basis points over the course of 4 days, which is actually, not a terrible rate of return. But if you then take that 19 basis points and you say, okay, well, it's a convention in finance sometimes for people to use 360 days, so I don't really care whether you use 360 or 365 or 366 if it's a leap year. But we'll just use 360 for the sake of argument. We'll divide by 4. That's 90 times the 19 basis points. And so that works out to actually, on an annualized basis, about 17%. All right, so let's start with that. So that isn't necessarily, you wouldn't necessarily be compelled to close that on the risk-free rate basis. On the other hand, if this option expired in 2 months' time, then you would, right? Because, well, actually, we can figure that out. So we'll just say 19 basis points times 6 is only 1.14%. So that would definitely fall into the area where you would close it. So that's the first thing I would say. The second thing I would say is that in this, I wanted to use a really short dated option as an example, also because, and I've talked about this a little bit, the convexity, you're short a lot of gamma when you're short these options. And I don't like being, even if there's a de minimis margin requirement, it would not be my choice to say, you know what, I think the chances that this thing expires worthless are very high, and they probably are decently high. The options market would actually suggest that these have a 91% chance of expiring out of the money. That's the implied probability that those expire worthless. So you can say it's a very high chance that the stock does not fall below 88.5. And on an annualized basis, the risk-free rate is still decent. But in a stock like Netflix, I would probably close these anyway. And the reason for that is because in this particular instance, we're dealing with a slightly higher volatility stock. So I will tend to look at these things, with a little bit of context. So the risk-free rate is just a general rule. Like I would say, why would you continue to be short options if you could, if you could get the risk-free rate and that would be as good or better? There would just be no reason. No matter whatever probability you assign to Netflix going to zero, for example, and it is very, very low, it's not completely zero, right? 1 in a million. I don't really care what you think that number is, or that it falls 25% because of something happening. The risk-free rate is money is money good. You're going to get it. So you need to have a rate of return that's substantially higher. Now, it is interesting because when you start thinking about the context of the individual stock, this is a little bit like when you're trying to figure out what the appropriate discount rate is. So if you're using something like a discounted cash flow analysis for a business, and you're saying, well, what's the appropriate discount rate? Is it the same for every business or for all stocks? It isn't. And so you have sort of different rates of return that you require from different types of investments. So you will tend to, make some minor modifications to adjust. In this particular instance, you're dealing with a stock that has a 30-day realized volatility right now that is 36.9-ish. So this is, I'll just get rid of the implied volatility, and that's what the trailing 30-day is. And that's obviously considerably greater than the implied volatility for equities generally, which we'll use SPY. Why not? Hopefully I can get this thing to update and we can compare that. So, I will look at something like this and say, okay, well, actually my requirement for that rate of return in something like, before I'm going to close it, in a name like Netflix, which is considerably higher volatility, as we can see here, is also going to be higher, right? So if I'm not going to be willing to be short a put in SPY at the risk, at anything approaching the risk-free rate, then I'm not going to be willing to be short a put in Netflix unless it's higher still. I mentioned Netflix because I actually wrote an article about Netflix over the weekend. My point being that with all of the noise going on, and we've talked about this one a little bit on prior live streams, with all the noise going on with the deal, Paramount, Warner, and so on, the question then becomes, well, what fate befalls Netflix if they do not manage to get Warner Brothers? Is that a complete disaster? I don't think so. I think that this would be a stronger company with the two put together. I think that part is reasonably sure. I am kind of interested in the degree to which the Ellison family riches back the Paramount Skydance bid. And the reason is because, and I'm not sure I mentioned this when we talked about it before, this is a much smaller company, Paramount, trying to swallow the whale. So you're dealing with a $15 billion market capitalization, $28 billion enterprise value in Paramount. And they've made a bid for Warner Brothers that's $103 billion and change. So it's very it's a very chunky chunky number. Anyway, hopefully that answers the question on the risk-free rate. So I will leave you to it, but be sure to follow up if you have additional questions about that. Okay, so Ranjana Gupta asks, "Hi Mike, how would you play the cannabis stocks or ETFs? Please draw up a trade." So I will. I tell you, this is not an area that I traffic in. To be honest, you'll pardon the pun there, but I will say that there are a couple ETFs I think that one could play. This is one of them. So CNBS for cannabis, and we'll take a look at what's in here. Full disclosure, this is run by Tim Seymour. Tim Seymour is an acquaintance of mine from CNBC, as you probably know. But, he has followed this space quite a lot, and so, he has a lot of different, things in here, and you can see that it's obviously backed by so they must have some collateral against some of the other things that they're doing, but he has a decent bit in cash. It looks like he's got about $42.25 million in cash, but you can see that he has exposure to a number of different names. I'm not necessarily recommending this one. This is just one that I happen to know about. Makes sense to me. I would say point yourself in the direction of somebody who knows more about the cannabis trade than I do, since they may know who's best poised to take advantage of things. Of course, the reclassification by the Trump administration is meaningful, and I would presume bullish for most of the space. And for those that don't know, what the administration said they were going to do last week was change the classification for marijuana, THC, things like that, from its current class, where it's basically in the same set of controlled substances as heroin, and move it into the same set of controlled substances such as Tylenol with codeine, things of this nature. So a very different regulatory class of controlled substances, and presumably good for the industry. You combine that with the fact that I think that in a lot of places where, at the state level, where they had endeavored to regulate this as an industry, I think a lot of politicians, had dollar signs in their eyes. And in the course of legalizing it, they made it overly burdensome and expensive for people who had previously been in the industry illicitly to become legit. And many of them did become legit because they wanted to be legit, but, it was simply not very profitable for them to do so. Little bit of, I don't know, I'm not sure if government overreach is the right way to describe it, but it's maybe not that surprising when you see something like that happen. And my understanding is that there are a number of locales that are looking to, to backpedal a little bit from the overly onerous and burdensome regulatory requirements for those in the industry that are looking to go legit, which we would hope that they would. So, we do have that. So, Jim Howard then says, Mike, are there any industrials that you like at this point? How much weight are you placing on the transport at this time to guide overall S&P outlook? So I think the transports can be insightful. For those that don't know, there's kind of an old heuristic in the investment world where people will say basically, as go the transports. The logic of that is that when the economy is humming, then you're going to see a lot of things, being shipped and moving around. And I generally would agree with that. Now, I have had my own set of troubles, as most who have watched this for some time will know. FedEx, always the bane of my existence, is a part of the transports. And, the airlines are part of the transports as well. And, sometimes they're interesting, sometimes less. I happen to like Delta amongst the major carriers best. There was a period of time when United Airlines actually got more attractive just because it was trading at such a huge discount. I think Delta is being well operated, and I think United's probably a close second amongst the major carriers. Southwest obviously was badly beaten up. They have some serious upgrading to do in their software. Apparently, they just had really not invested quite enough, and they're overly sensitive to it because the unlike the conventional hub spoke model of the major carriers, theirs was a situation where it really required some good optimization, because oftentimes planes were going from location A to B, stopping there, picking people up, dropping people off, going from B to C, C to D, and so on. And because of this, if any one of the stops along the way gets disrupted, it can have, massive complications that sort of proliferate throughout their entire scheduling system. So let's just take a quick look at other industrials here. And I'm going to, I saw that question pop up before we got started. And so what I did was I started to run a more basic screen than I have done before that I thought would probably better capture some industrials, because some industrials are, let's face it, they're not as fast growing. So what I'm looking for now are still going to be companies that are growing as fast, let's say, as the economy overall, that are growing earnings faster than that. A lot of those of you who have watched me for some time know that from my perspective, I don't really see a whole lot of sense in going out and trying to pick stocks that don't accomplish at least those objectives. But industrials are not the fastest growing sector. One other thing about industrials that sometimes makes them a little bit less compelling is the fact that they can, you might end up with something that's a little bit more capital intensive than some other businesses. If you imagine the ideal business would mint money and require virtually no capital at all. And, less desirable would be businesses that have massive capital requirements, nominal return on capital, return on equity, and in, only a modestly growing business. So some of the names that I do like, United Rentals. This actually has been a real grower. This is a name that Karen Feinerman has spoken about quite a lot. This was always one of her. She's a value investor, as many watching will probably know. We're dealing with a company that, as you can see here, expected to do about $42.50 full year in adjusted EPS per share. So it's trading at less than 20 times the full year numbers and well less than 20 times the forward numbers, with decent growth, reasonably solid free cash flow. So this is a name that I think is definitely one that you could potentially take a look at. What else we got in here? I guess maybe let's take a look at, Comfort. I'm not sure that I think of it as a traditional industrial, but let's see here. We've got Comfort Systems, HVAC business. This one looks pretty decent to me. Meets most of my criteria. Again, it's got the growth both top and bottom line, as we can see here. Free cash flow numbers aren't quite as attractive as United Rentals, but these are basic businesses and pretty solid. This is, of course, trading at a much higher multiple, as you can see here. So it's got a very good growth rate, but the multiple's probably just a little on the rich side for me at these levels, but certainly one to keep your eye on if it manages to pull back a bit. The growth rate is anticipated to slow next year, so paying well over 30 times forward with a 17% year-on-year anticipated adjusted net income growth rate isn't as sexy. But it is, it certainly is a grower. Let's see what else we've got in here that might be of interest. Here's one that's let's see what we got here. Bear with me for a second while I just get a couple other filters going. Again, normally I made some minor adjustments just to make sure that I was sort of widening out the screen just a little bit. What else we got here? Let's see. We have, Expeditors. So this, you were talking about logistics. Let's take a look at this one. Little bit of an issue in here, slowing down a bit, but this has had very solid top-line growth for the last couple of years, and very solid year-on-year adjusted EPS growth. So I think that is one. And actually, I had mentioned, I mentioned this one, CACI. I think I wrote up an article about this a couple weeks ago, but so CACI, if you don't know, I did mention this. Who did we have on? I was on Fast Money, and they were at a conference. They brought on the CEO of one of the defense companies. So CACI they do a bunch of different things, mostly government contracts. They do tracking applications. They have basically zero trust cybersecurity systems that they have. So there's a lot of sort of interesting. I think they've got about 7 different business segments, and as you can see, I mean, this is another situation where pretty consistent top line growth, as we can see here, many years now. Also, very good numbers on the bottom line. Again, for many years, and look, this is also happens happily to be trading at a fairly reasonable valuation when we take a look at how it's priced versus next year. So $31.50 a share, $5.67 a share. So that works out to 18 times forward earnings. Anticipated $740 million of free cash flow versus a $15.6 billion enterprise value. So we're looking at free cash flow of almost 5%, 4.75-ish or thereabouts. So this is a name that I like. And look, I mean, it's down 1% today. So that would be one that I would consider as well. All right. 11506 Steven, you've mentioned only investing in companies growing faster than the economy. So just to be clear, I'm assuming that most people who are watching and most people who are investing already have exposure to something like the S&P 500. So the way I look at it, if I'm going to start picking out stocks to add to a portfolio, I'm looking for stocks that have a chance of outperforming the broad market index. So if you consider, I mean, this is a very different situation, by the way, than if you're Berkshire Hathaway, right? So if you're Warren Buffett or now Greg Abel and you're out there trying to look for businesses to invest in, and they're looking at it as if they're going to buy and hold a business forever, they don't mind buying companies that aren't growing if they think the returns are decent and there is enough liquidity for them to make a suitable investment. For most retail investors, though, chances are the S&P 500 kind of gets you, where you're going in terms of equity exposure. And most individuals are probably not likely to outperform it. But if you are going to outperform it, how are you likely to outperform it? The people that I know personally who have done are all people who had the good fortune to say, okay, here's a secular trend. I believe in it. I'm going to invest in it. And then they buy relatively fast-growing companies and then hold on to them for a decent length of time. I have a friend, for example, who has, a mid-six-figure position in NVIDIA. And the reason he has a position in NVIDIA is because many years ago, E-Trade was offering some deal. Like if you open up an E-Trade account, put a few $100s in, and we'll match whatever you put in, and then you can pick a stock of your choosing. And the match, of course, basically is that they were margining whatever was going to be in there. They're basically giving them the benefit of it. And so he opened it. I don't know what he did. Put like $500 into an account and picked a stock he liked. And then they were going to match it with the amount of money that he had put in. And, he picked NVIDIA or something like that. And then he promptly forgot that he had this account. And this is early days. And I think NVIDIA went up 80,000% in the meantime. So it was just some absolute madness what happened. And that would not have happened by investing in Kroger's or Albertsons. So, when and I'm assuming that people who are watching, this is kind of the view that you're taking as well. Like you're going to invest in equities. You've got your 401k going in there. You're buying SPY or IVV or VOO or some S&P proxy. Maybe you have some kind of a targeted retirement date investment plan. But absent all of that, if you're going to go out and pick stocks, and if you're going to in turn trade options on those stocks, this is a more actively managed portion of the portfolio where your hope is to outperform, these more conventional investment and well-diversified, it should be said, investment approaches. So that's just a quick point I would make. So you have NeoCloud and SMH, the semiconductor ETF, seems stuck in the mud. Is there a case for dividend or value here? I will say one other, so I will add one quick thing, and that is, I believe I've shown that chart. Maybe I can find it. We had a chart that we showed, I think it was during office hours with Mark. And it was a chart that JP Morgan, others have shared this too. And basically what it is it shows the relationship between the price to earnings ratio, just as for the market generally, for the S&P, and the forward 10-year returns. Let's see if I can find this thing. I'm pretty sure, where was that? I had a chart like that. Let me see if I can find it. It's a scatter plot, and it's not particularly compelling. Here it is. Got it. So here we are. So as you can see, and as one might expect, the higher the multiple you pay for stocks, the lower the subsequent 10-year returns would appear to be. And this is the trailing price to earnings. Now, the unfortunate part, I hate to say, is that we're actually probably in this region over here at this point in terms of trailing 12-month earnings. Now, I want to caveat that by saying, and I have actually said something along these lines on more than one occasion during these live streams, the profitability that some of these companies are enjoying is unlike anything I've ever seen. I never remember seeing companies that are akin to an NVIDIA that are growing as fast, are as big as they are, and continuing to grow quickly, and have net after-tax adjusted income that is more than 50%, net income margins that are greater than 50%, net of taxes. That is pretty unprecedented. I don't know that there has ever been a time where the largest companies, the largest publicly traded companies in the world, were able to grow their top line by 50 to 100%, have more than 50% adjusted net income margins after taxes, and also at the same size and scale that they are now. I mean, NVIDIA being 50, its market capitalization being 15% of the United States GDP. by itself. I mean, these kinds of things. So I want to, whatever comments I make about charts like this one, which are very alarming, it should be said, because you look at that and the Howard Marks of the world are going to sit there and say, how can you invest in equities at this price? And I would say, there's a lot of data in here, and that definitely doesn't look all that positive. But, there is something a little bit different about what's happening right now. And that's always a little bit alarming, too, when you hear, oh, well, it's different this time. People would say that during the internet bubble or this or that. But those companies weren't immensely profitable. Everybody said they're going to be the transformative technology, but they weren't making money. People now feel that way about AI, but some of the businesses involved are indeed making a lot of money, more money than any company has ever made before. So, what does this tell us? I mean, could that potentially be a risk? I mean, I guess the closest thing I could come to is if you put Broadcom together with NVIDIA and a couple other key players, maybe throw in AMD for good measure. I would say, I guess the closest thing I can come up with is Standard Oil. I mean, I don't think there was any circumstance in history where any of I'd actually have to go back and look. I'm not 100% sure. I was paying a little bit of attention to this because there was a point in time when, in the early 1900s, there was a situation where a couple big railroad operators were trying to corner the market. Was it Northern Pacific, maybe? In any case, I'd have to go back and take a look at the railroads and see, whether they had a circumstance that was where they were generating profits like that. But as far as I know, this is kind of unprecedented. So I would just offer that. I don't think there's anything disastrous, by the way. Some value stocks, I mentioned Kroger before because I've seen this thing trading down to 10 times. It's a little above that now. So the anticipated earnings for next year, 533. When this got down to about 11 times forward a while back, I think I recommended it on the channel just by saying, look, I mean, this thing's gotten so cheap. Critical business. I mean, grocery stores are going to continue to exist. Not saying it's not a highly competitive business, a very low margin business. It is all of those things. But there's also a lot of consolidation in the industry, so they've kind of locked up their little areas, their corners of the market. And, if it gets down into that range, if you start to see this thing at 11 times forward or a little bit less than that, I think that starts to begin to get, pretty attractive. I mean, we're also here looking at a business that's also going to be generating about 5% free cash flow yield. So we'll just use round numbers, 3 billion versus 60, right? So not terrible if you're thinking about value. Don't mind that. SMH, I'm a little bit surprised because, the semis have done quite well. This is our covered call ETF that is on the semis, and as you can see, the total returns for the last year have been quite good, actually. So, are we sure you? I don't know about stuck in the mud. Maybe they've kind of been not doing great since reaching their highs back here in October, but I mean, they're still substantially higher on the year. I mean, I'm not sure what you might. Is that ticker definitely correct that you're talking there? I don't. I guess the short version is I don't really look at semis as an underperforming sector this year. So maybe you're just referring to the last couple of days. I'm not entirely clear on that, but maybe you can give us some clarification. Monday morning quarterback, Mike. Given today's drop in strategy, where would you enter a 1 by 2 put spread again? Okay, well let's take a look at this thing. It definitely is interesting. I mean, Bitcoin, wow. I mean, it just does not seem to be able to catch a break here. So let's just extend out a little bit. Actually, let's look at Bitcoin first, because this is what I usually have done, is look first to Bitcoin and say, where I think is a compelling level. I think I have pointed out on more than one occasion that I wonder whether we might test this right here. I just feel like that's a lot of people have it in their sights at this point. So, I mean, does it have to get right down to the penny of this number? It doesn't, but it does feel a bit like we're heading in that direction, would be my sense of it. So that works out to about a 13.5% discount to where we are right now. So I would probably use this as, this is the point where I really am kind of getting interested in a sort of back up the truck moment. It just continues to feel heavy. I mean, I don't see any reason to, at this point, to say that technically it's regained its footing. It has not. So we'll start with that and understand that Bitcoin is ultimately going to propel strategy. Strategy is levered to Bitcoin, and we're at a $61.5 billion enterprise value. But remember, as I pointed out, about $3.2 billion is sort of like almost is near convertible at the current level. So that's about $49.8 billion. The vagaries of how strategy is going to behave relative to Bitcoin, we will see. I would use Bitcoin, though, as my marker for where I would be interested in getting long in this one as a levered play to the upside. So 13.5% to the downside. Now, this thing, as I pointed out, because they've got 651,000, I believe, is the number now. So that works out to, 56 billion. So, to me, you don't get, it is not that you're buying strategy at a big discount necessarily to Bitcoin, but you are getting more participation to the upside in Bitcoin for that first move up, because synthetically what's gone on here is that with their convertible securities, they've financed incremental Bitcoin purchases. That's introduced a bit of leverage onto the balance sheet. So that leverage, because that's debt, you should expect the equity volatility should be whatever that leverage ratio is, which is 61.5 versus 46.5. So about 1.3 times levered. So you should expect the volatility to be about that much higher. But I don't think it's going to get that much cheaper relative to I mean, some people, like I said, they might be looking at this number, and that's not entirely a reasonable way to think about it, because, like I said, all of these convertible instruments are not convertible right here. But even if you did that would be the most conservative approach you could take. Even then, that's 61.5 versus 56. So then it's only trading at about a 10% discount. So this is, a 10% premium. So to me, I think that the relative valuation for strategy is attractive here and now. But I think that Bitcoin has a little bit more downside. So if I'm looking at that 1x2, I'm going to say, all right, well, I said 13.5%, 1.3, that's about 17%, 16, 17%. So that's essentially where we would be willing to get long. So we'll just pull up the options play application. Where's my cursor? Oops. And we will structure one as follows. Some of these delays are probably the fault of my machine, not necessarily options play's fault. I am due to upgrade this thing. I upgrade the machines every 3 to 4 years, and this one, I believe, is now overdue. Oops. We'll put MicroStrategy in here. We've been languishing around in this whole area for a little bit of time, but all right, let's see. So 17%. That would be conservative. I mean, even 16%, so we'll just say 0.84. So that's about 140. So if you were going to buy, let's say, a 160 put, and you could sell a couple, see what we get here. So let's first try to do this for about even, or we'll see if we can get any. Here, this is about even right here. I mean, that already looks pretty good. Right? So essentially you would be effectively, because that's almost even money. These wing options are going to decay more rapidly. And, you know, worst case, you're going to put the stock at $25 below the short put strike as an effective purchase price, plus $1 in this case, right? So you're trading it for $1. That's bid to ask. If we go to the mid, you know, so you're going to probably find something somewhere in there. So we'll call it a 75-cent debit, right? That would be reasonable. De minimis. Really, that's like a couple days worth of decay, and you're going to see more decay in those wing options. So in this particular instance, you're effectively going to get long the stock at $1.10. We'll call it whatever. We'll call it 111. That's the worst case. So that's a 31.5% discount to the current stock price. Now, based on that leverage that we were talking about before, so 31.5%. divided by 1.3, that's like a 24% discount in Bitcoin itself. So I think this is a fine strategy right here. You know, for those who are inclined. If you are preferring to use something a little bit nearer dated, because that is a little bit further out there, you know, you might look at something like this. 155.35, that expires in just over 6 weeks. I think that's very attractive. So yeah, I hope that helps. And those are the things to think about. So think about the volatility and the leverage. Think about the convert strikes on the convertible preferred and debt, which in many cases is much, much higher. And if you're using the most conservative assumption, then just use the enterprise value. So add the equity and the debt on the downside, right? Knowing that on the upside, you're actually going to get more participation because it's not convertible straight away. So that's a decent way to think about it. Ambassador, how are you, sir? Hello and Merry Christmas. Merry Christmas to you. It's actually my wife's birthday before it is Christmas. Her birthday is on the 18th, so Thursday. That's Thursday, right? Yeah, Thursday. Make sure I have that one right. Hi, Mike. So, salty dinosaur egg. Hi, Mike. Nice handle, by the way. Hi, Mike. Wanted to ask about repairing a flubbed Lulu trade. You got a 195-200 March call spread. Is there any strategy to capitalize on the long while staying covered? Can't have naked shorts. I'm assuming you mean you cannot have naked short options? I'm guessing. Yeah, let's see here. Ugh. There you go. Now you have the March call. Oh, that's a long dated call spread. You have the 195, 200 call spread. It's long dated. A flub Lulu trade. You have a 195, 200 March call spread. Can't have naked to capitalize on the long while staying covered. Can't have naked. So Salty Dino. Yeah, can't have a net short options position. Okay. But you're in the 195 200 long, if I'm reading you correctly. So, I think one of the things we're seeing here is that because as everyone's observing, that call spread is now well in the money. Both strikes are in the money. The 200s at this point have a 62 delta. But you'll also observe that this is only trading for, give or take, about half of its potential value. Even slightly less. To 237. So, potentially a $5 call spread. Well, I guess the first thing I would say is it's not a flubbed trade necessarily. You've probably noticed that this thing is just not moving around a whole lot with the stock. Take a look at this. So this is a 66 delta call, the 195s, and the 200s are 62. That means that the net delta of the trade is only 4 deltas. That means that for every dollar that Lulu moves instantaneously, this trade is just only going to move about 4 cents. So, it's not a flubbed trade per se, but it's not going to do much, is the other thing, right? So I don't know if, when, or how you put this thing on. Maybe you bought it when Lulu was a little bit lower here, and perhaps you paid 30% for it, 40%. My attitude would be I probably wouldn't use a trade like this to make a bullish bet in Lulu. I might be more inclined to use a calendar where I have a longer dated call and I just use it, what we call the poor man's buy right, where you are longer dated calls that could be at the money, maybe slightly in the money, generally at a lower strike, than nearer dated calls that I would sell. Just being cautious about the potential gamma of a situation like that in and around earnings. And the next one, because that's so far out in time, so you've got the Marches. So this is actually not going to capture that. What's interesting, by the way, this kind of goes to something else we were talking about. We were looking at this name recently because it was a long time Holly Index name, not as much recently, and we were talking about the fact that some of the alternative data for Lulu looked a little bit better than it did for some of their competitors. And I had mentioned, among other things, that American Express had a new benefit where you were getting a $75 credit or something at Lulu, which have not yet availed myself of, and probably need to make a point to do that before the year is out. Actually, maybe before the week is out, and get something, even though it's not on the Holly Index, and she prefers things from Fiore. Maybe I'll go to Lulu for old time's sake, try to take advantage of that. The data lag changes from what's this? So placers, that's an interesting one. So my placer data is getting a lag in it now. Not crazy about that. Why? Okay. In any case, what I would think about doing instead would be holding on to, if you want to hold on to the 195s, they're already in the money. That's fine. Look, these things are $20 in the money. These things are basically trading for very close to intrinsic value right now. Right? So those things are $21.30 in the money. So you're paying a relatively nominal sum to essentially have a hedged equity exposure to Lulu here. in those call options. So instead, maybe contemplate using an out-of-the-money, shorter-dated call. So you could roll up and in on these March 200s. So let's say we wanted to go out to like 46 days, which I think would be a reasonable expiration. I mean, I would actually probably go up in this neighborhood here. And you get into something that looks a little bit more like this. And then you could, roll further out. And by the way, one of the things you could look to do is potentially roll these, not when at expiration, but treat this as like a 20 to 25 day trade. So when those things get, relatively short amount of like 2 to 3 weeks left on them, then just roll them again as needed. And what's going to end up happening here is you're going to say, well, this is, in terms of premium, this looks like it's less, but that's $5.50 of extrinsic premium. You have more room to the upside. So I don't know whether this is something that your account would permit in terms of capital, because this will have a slightly higher capital requirement because you're going to be repurchasing that in the money 200 that's long dated and selling a shorter dated out of the money call. But that's just going to give you a little bit more of a tailwind. You're going to have some theta, and you're also going to have, by the way, more delta, right? So you're now going to have more upside exposure. This is a 31 delta versus 66, so you're basically looking at a 35 delta trade now. So for every dollar that Lulu moves, this would move by 35 cents. Today it's up $1.32. You'd be up 50, 60 cents on the trade. So there's something I would contemplate for that. Okay. Alex V 659. Hi Mike. Micron will report on Wednesday they've decided to drop crucial retail brand. How do you think it'll affect the sentiment? What would be the strategy now? Well, rather than taking a look at my sentiment analysis, why don't we just see what the market's sentiment analysis is? Let's just confirm the dates here. So, yep, at least Bloomberg. We could go to the investor relations website always to double check. We can do that too if we want. I'm not going to bother with that for now. I'm just going to assume that this is correct, and I will double check that by taking a look at the term structure, because I'm assuming that the options market participants have done the requisite homework. So there we have it. We can see that the implied volatility is all here in the front. This thing has moved on average about 6.3%, and not that much recently, as we can see here. So let's take a look at what the technical indicators have in terms of sentiment, and then we're going to take a look at the options market, see what that's got in terms of sentiment. Kind of a mixed bag in here. So this is one of the better performing technical indicators, but that one looks like it has a lot of trades. I don't like those in general. I will typically rule that out. So we're going to just go back. So these things are just blowing in and out. And it doesn't really help you that much for me to show you something like that, because are you actually going to do anything with that? Probably not. Almost every other technical indicator that has shown any profitability this year, though, is bullish, as you can see. So we can take a look at this one, which has actually outperformed the S&P. And this went long over here. And let's take a look at what's going on in the options market as well. Call volume outpacing put volume fairly comfortably, it appears. We're going to just take a look in here. Just look at this over the last couple of months. Or last month, why not? Well, there's a reason why not, because it's not showing me. There we are. I wouldn't say that the trend is too pronounced. And finally, just we'll take a look at some long-term trends and financials. Wow, that thing is really, yeah, it's a little... I would look at this and say, especially in here, the thing that would get my attention is, how far above the 50-day it has gotten. So, one of the things I will look at from time to time, and this is just more of a timing issue. This is not so much of, this does not go, as you would guess, into my screening process. So the screening process is largely driven off of fundamentals and is the stock at or above long-term moving averages. But once I've done that, this is something that I will take a look at, which is how far above the 50 has something gotten. And I just use that as a sort of a short-term measure of exuberance. Because oftentimes when you see this as a percentage get too high, doesn't mean that it's, a disaster, but it does mean that maybe, you're reaching just as everybody else is doing that. And you can see that in a couple instances here. In fact, not just a couple. I mean, that definitely seems to hold up. And we are right now a little extended, I would say, up there. But it has obviously given a decent piece of that back. So we're now getting back to this trend line, which is good. So just in terms of technicals, we now have a sense of what the short-term technical indicators have to say, what this has got in all of it. And let's just take a look at some fundamentals. $25.39. This, by the way, I mean, for what it's worth, this is the more commoditized space in technology. So, pricing does go into it. I didn't realize that the street was now as ambitious as it is for next year's earnings estimates. They're expecting 26.5% year-on-year growth. Yeah, I mean, look, I think it's healthy that it has pulled back off of that sort of overextended relative to the 50. I'm going to say I like this one. And more than that, I mean, I'm almost sure we have this one in Chippy. I don't think we have it in Alti. I didn't see it on my... We have it in here. We don't. That's interesting. And we do have it here. So we've got about 40 million bucks worth of it. This is a discretionary fund, so yeah, I guess I mean, I have to say that, in general, I'm supportive of it. So let's just talk a lot about what the options trade should be. And let's go back to this and see what we think of the options premium. Is it elevated or not? Oops, sorry. Wrong stock. So the straddle is priced at, we'll call it 1170. Yeah, so 23.5-ish. So it's almost 10% of the current stock price. That's more than the historical move has been. You know what we haven't used lately? These unusual whales. And I should have. So we go over to this. And let's have a look. Again, this is just force of habit. It's not because I don't like unusual whales and the stuff that they're doing. Absolutely do. But, and this is one of the things where I should really have this thing queued up ahead of time. One of the things that I think is always impressive in here is there. My stock data dark pool. Just because I think from a picture perspective, it can be interesting. Mm-hmm. So you can see here, this is the part we really want to look at, which is down here. I'm going to put that in the middle of my screen and blow it up a little. Did I do that right? No, I did not. You can get a sense of what the size of the average moves have been relative to what is implied right now. And you can see there have been a couple instances where you had bigger moves. But generally, they're inside of these lines. So, and this is, this is a 16-quarter history. So my thinking is that if you're just going to do buy rights and things like that, usually I say, just as a simple rule of thumb, probably better not to sell into the move. But in this particular case, actually, options premiums look like they're pretty elevated, so I don't mind being net short options in this particular instance. And we already saw that 50-day. I think that those technical levels might not be a bad place to sort of, choose your setups in terms of where you would potentially be willing to, get long the stock. So I might think about doing something like a call spread risk reversal in here. Again, only in this case willing to do this because I think the options are actually quite, and I'm probably not going to say the 230s. Maybe we'll go out to like the 240s here on the long side. And so we're looking for something along these lines. And I'm just going to take one quick peek. And so that would get us long around 220. Oops. Don't like that. It's not quite as much of a discount as I would like. I'd kind of like to get in, well, 220 is right around the 50. So that probably works. Oops. What happened to the one I was working on? Obviously shows I was looking at Netflix before. So, yeah, I mean, I would probably be inclined to bring this down a little bit. Let's get this down around. I want a little bit more of a downside buffer, I think. And remember that when this thing, you could have a net outlay, but those wings are going to come in harder after the print. So, this would be a way that I would think about it. So a little bit of an outlay, I don't mind too much. Let's just take a look at what the delta is, bearing in mind that that delta is also going to be affected by the vol crush that's going to take place afterwards. So where is the stock right now? 237, 240. Yeah, something like this I think makes sense. Just because I think options do have a pretty good bid to them, and I'd be inclined to take advantage of that. By the way, I'm kind of moving around here, and hopefully the audio is working. We're using a different microphone today. I hope it sounds okay. We're going to be doing a little bit of testing. Oh, and on Wednesday, I'm going to be joined by Josh Canner, colleague. He's the YieldMax brand manager. And he's also a very active investor and trader, so he's going to be sharing some of his thoughts from his own trading account when he joins me. But yeah, I think that's a decent way to play Micron into the print. All right, so their reasoning is trading lower margin consumer business for higher margin AI business seems like a reasonable idea, and if AI blows up, they should be able to switch back quickly. Okay, I'll go along with that. Okay, and with that, it looks like I have chewed up a valuable hour of your day. And for those of you who spend it with me, I appreciate it, your time and attention. Like, subscribe, and all that kind of good stuff. And tune in again on Wednesday at 4:15 Eastern when I will be joined by Josh. And hopefully, if everything works the way I expect, I will also be joined tomorrow by Mark Guthner for a session of office hours. And I hope you'll be able to join us for that as well. Thank you very much for watching.